Hey everyone, welcome into another edition of Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I am Dion Rabone, reporter at the Wall Street Journal. Today I am breaking down and explaining the three most important things you need to be watching out for this week. It's the week before jobs week, and it might be a time to sleep, but stay woke, all right? We're talking through some big time reports that I think could really move the market this week. We've got the new home sales report that's out Tuesday. Not usually a big economic report, but I think this week it could be. Stick with me on that. It's all about inflation. We also get the PCE report and core PCE in this week's income and outlays report that's out on Friday. And we get some big consumer sentiment data. We actually get consumer sentiment and consumer confidence in the same week. Those are both going to be coming out this week. So listen, without further ado, let's talk through it. Let's get into the new home sales report that is coming out on Tuesday. That's tomorrow. I want to put up here on your screen just a chart showing what we've seen from new home sales. Now, as you can see on the left hand of your screen, those numbers are just coming down. And that means that, the number of homes sold have been coming down, the housing market overall slowing down, and you saw really diving to almost 500,000 new homes sold per month. And then you see that pickup, that's right around July, and you see it kind of consistently coming back to where we're almost near that 700,000 number again last month. And so what we've seen is a real reacceleration of home sales, and that suggests that, maybe inflation's picking back up. Now, what we did see on the existing home sales report, if you watched Market Takes last week, we talked through the existing home sales report that came out and showed a pickup unexpectedly. So we've seen overall the housing market really picking back up across the board, but new home sales have been rising a lot faster than existing home sales. And unlike those existing home sales numbers, the new home sales numbers are at or above pre-pandemic levels. So this increase we're seeing really is historically significant. Now, the expectation for this upcoming report that we get tomorrow is that we're going to see a negative 1.2% change month over month, as in a decline, the first time since March, dropping to 670,000 homes sold. But as you can see there, we are reaccelerating. If we did see that, that might be the stopping of a trend. Now, big picture, here's why this is important. This chart illustrating that pickup that we had seen for new home sales. The Fed really wants the economy to slow down, and we have seen just consistent demand in the housing sector, and we're seeing that play out a lot in new home sales because there's so much supply. There's just a lot more supply, about 7.5 months of housing supply for new home sales versus about 3 months of supply for existing home sales, as in if everyone went out and bought, at the pace that they are, here's how much housing would be left, or here's how much of a supply of housing would be left. On new home sales, it's about 7.6 months, and for use and for existing homes, it's about 3 months. So just a big difference there, and that's why you're seeing this big acceleration. Last month, we saw a 4.1% increase, about 12% year over year, so really just picking up in a big way. And housing is the biggest contributor to this core inflation that the Fed is watching. And we have seen those core numbers really continue to rise higher and continue to show strength overall in the housing market. And that's something that, of course, the Fed is going to be watching and that you should be watching because, again, it could give us some early signs of what's going on with inflation. The NAHB Housing Market Index also beat expectations. Last month, rising to 55, the highest since July of 2022. Housing starts were up huge, expected to decline, but actually rose 22% to the strongest since May of 2022. So again, overall, we are seeing housing pick back up. We will see if that continues. We also get the Fed's favored measure of inflation, the personal consumption expenditures report, the PCE. That's been coming in. We have seen CPI really continuing to slow down and drop towards the Fed's 2% target. But want to put a chart up here on your screen so you can just see what's been happening with PCE. Now, as you see, since that June number, you've seen really through the course of 2022 into 2023, the numbers kind of consistently coming down. But then the last number that's there on your screen, that April number, you see it picked back up. So is that a blip, or is that the start of a trend where we could actually be picking back up? That's what this report is going to tell us this week. If inflation is picking back up, that could be a sign the Fed's got to raise even more. They signaled at their last meeting the Fed sees raising rates 2 more times this year. That could go up, and that could be something that really disturbs the market. I think if you'd have told me back in March that the Fed was going to signal 2 more rate hikes after getting to 5%, as in moving to 5.5% and saying, hey, maybe we could go even higher, I would have told you the market's probably going to sell off, that stocks are going to get killed, especially in the tech sector. That has not happened. But if we see inflation continuing to pick up, because like we said, you look here at this chart, you're seeing, even though we got a little pickup last month, a consistent decline moving toward the Fed's 2% target. And this chart just illustrating that we have seen these numbers come down, but we got that pickup. And if that pickup is a trend or the start of a trend rather than just, a one-off, and, inflation can move up and down, and that's the overall index, that could be big for the Fed, and that could be big for the overall inflation picture. We're talking about PCE core. That chart I showed you was just overall PCE, but the core index rose to 4.7% year over year. That was even higher. That's expected to drop to 4.6%. Core PCE strips out volatile food and gas prices, because those tend to move up and down, and the Fed doesn't have a lot of control over food and gas prices. But as we know, the Fed watches that very clearly, and last month it rose to 4.7%. And Jay Powell actually, when he was asked about, okay, why are you guys forecasting 2 more rate increases this year? He said, well, look at core PCE, look what's happening there. When he was asked about, okay, well, why do you guys expect the economy to be strong and unemployment not to rise as much? He said, oh, well, look at CPI. Look at how that's coming down back towards our target. So again, the Fed could be using PCE as a reason. If this core number picks up, it's expected to rise to 4.6%, so down from last month. But if that picks up, that could have major implications for the Fed and for the overall market. This is going to be big. You're going to want to look at not just PCE, but that core PCE number, core spending and services, of course, and core services X housing, aka that super core inflation number that we've been talking about on Market Takes for probably most of this year. So definitely going to want to look out for that. Also, just an interesting thing to note going on this week, we've got the second GDP estimate, the revision coming out later this week. That's not normally a big deal, and it may not be again, but economists now predicting that Q1 in the first quarter, GDP actually rose more than expected at 1.6% versus 1.3%, which is what that first estimate showed us. That would be big. It would really kind of dispel a lot of these recession worries and recession expectations that are right now baked into the market, and say, oh, nope, you know what, no recession, because we've got the economy growing even faster than we expected. That would be something that I think could move the market as well, especially the bond market. Last thing before we get out of here, let's talk about the University of Michigan Consumer Sentiment Index. I want to throw that chart up here on your screen right now. And I wanted to show this 10-year chart. This is going back 10 years, just so you can see where we are historically. Now, as you see, it's very clear there on the right side of your screen. We are at much lower levels of sentiment, as in sentiment is lower. People are less excited, less bullish about the economy, feeling less good than they have recently. And since the pandemic, really people's sentiment has been down. So as we're picking back up, you see that last little bar there on your screen, picking back up. But we are still very low, and sentiment is still much lower than it was before the pandemic. And this chart is really illustrating that folks are just generally having a more negative, more dour outlook about the overall economy. That may explain why, even though we have seen some of these overall economic data numbers trending higher where folks are still spending, we are seeing lower sentiment, and that has continued. But sentiment expected to rise to 64, maintaining the preliminary report that we got at the beginning of June, and picking back up from some of those very low and historically low levels we saw last year and at the beginning of this year. So listen, that's going to do it for us here on Market Takes. That was me breaking down the 3 things you need to watch out for. New home sales on Tuesday, and then you get the PCE report in that personal income and outlays report, as well as consumer sentiment from the University of Michigan. The Conference Board's index of consumer confidence comes out a little bit earlier this week. Want to watch that as well. Listen, I am Dion Rabowen, reporter at the Wall Street Journal. This was Market Takes. I hope you'll look forward and join us next week when we break down the jobs report on Friday. See you then.